Right now, a dollar isn't worth the same as it was yesterday, and nobody set that price in a room. The exchange rate between currencies isn't decided by a central authority or a government decree. It's determined by millions of transactions happening simultaneously across the globe. When you travel abroad, you're stepping into a marketplace just as real as your local grocery store, except the product being bought and sold is money itself. So what actually determines the price? Think of it like this. If everyone suddenly wants to rent apartments in one city, rents go up. The same happens with currency. When more people want to buy euros than sell them, the euro gets more expensive. When more people dump yen than buy it, the yen gets cheaper. Supply and demand, that's the engine. But here's where it gets interesting. What makes people want a currency in the first place? It's not sentiment, it's practical need. Businesses need dollars to buy American goods. Investors need yen because Japanese stocks look promising. Tourists need pesos to spend in Mexico. The health of a country's economy directly shapes how much its currency is worth. If the United States economy is growing, people want to invest there. They need dollars. Demand rises, the dollar strengthens. If inflation spikes in Europe, the euro becomes less attractive, it buys less stuff. People sell euros, supply floods the market, the euro weakens. Economic data is constantly released, job numbers, inflation figures, GDP growth. Each announcement ripples through the currency market instantly. Interest rates play a huge role too. When a country's central bank raises interest rates, savings accounts and bonds become more attractive. Foreign investors flock in to get higher returns. They need the local currency to invest. That currency appreciates. Lower rates, the opposite happens. Money flows out. The currency weakens. It's mechanical, not mysterious. Political stability matters too. When a government is unstable or there's civil unrest, investors get nervous. They pull money out. Currency sells off. Conversely, when a country is perceived as safe and well-governed, money flows in. The currency rises. A scandal, an election, a policy shift, any signal about a country's future can move the rate in minutes. Trade balances create pressure too. If a country exports way more than it imports, foreign buyers need its currency to pay for goods. That strengthens it. If a country imports way more than it exports, it needs to buy foreign currency to pay those bills. That weakens its own currency. The flow of goods creates a flow of currency. Speculation amplifies everything. Currency traders aren't just responding to current conditions, they're betting on future ones. If traders believe a currency will strengthen, they buy it now, hoping to sell it later at a profit. That buying pressure itself makes it strengthen. Belief becomes self-fulfilling. The opposite is true for currencies traders expect to weaken. Central banks can intervene directly, buying or selling their own currency to influence the rate. But they can't fight the market forever. Eventually, the underlying economic forces reassert themselves. It's like trying to hold a beach ball underwater. You can do it temporarily, but the pressure builds and it pops back up. Global events create sudden shifts too. A war, a pandemic, a natural disaster, anything that changes how the world perceives a country's future can move exchange rates sharply. In 2020, when lockdowns hit, people rushed to hold dollars because they perceived it as the safest currency. The dollar spiked. Panic creates volatility. So when you see exchange rates changing by the hour, you're not watching random noise. You're watching the collective judgment of millions of traders, investors, and businesses voting with their money about which economies are healthy and which are struggling. The rate is a price. And like all prices, it reflects what people are willing to pay. Exchange rates fluctuate because the world's economies are constantly changing. Growth accelerates, inflation rises, political winds shift, investors move money. There's no single person controlling it. It's a distributed system where supply and demand meet across borders every second of every day. That's how currency exchange rates are determined. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe if you want to understand how the financial systems around you actually work without the jargon or the sales pitch. This video is for educational and informational purposes only and is not financial advice. Always do your own research.